Good morning, everybody. Thanks very much for joining us today. Thanks very much also to UBS for hosting. We've moved into leather seats, which is extraordinary, so that's fantastic for us. In case you don't know me, my name's Richard Betts. I'm the publisher at Property EU. Very pleased to have a fantastic panel. And also Rick Lewis here, who's Chief Executive and Chairman of Tristan Capital Partners, who's going to give us a speech shortly. Thank you, Rick.
Good morning. Some of you here today think you came thinking that you were going to listen to a TED-style talk on investing. Well, you didn't pay anything for this talk, and Ted's not here. A couple of years ago, a dear friend said this to me: life's tricky. Stay in your magic. I thought she made it up herself because she's that kind of wonderful character. But since I've seen it posted on Instagram, BuzzFeed, Twitter, I'm not sure where. But whatever the origin, it doesn't really matter. Because in that instant, in that moment, I had one of those lightning bolt moments. With that short note, she reminded me of what I've always believed and tried to live by. She put into words how I've negotiated most of my major life events and what consciously or subconsciously has guided me through the startup and executive management of the 3 companies I've founded to date. It's the importance of developing, refining, perfecting, and being at peace with your own special brand of magic. So who am I? What have I developed over the years? What's the background to my magic? I think I learn quickly. I think I read situations well, and I think I'm equally comfortable with detail and the big picture. I think I'm an eager and astute student of human behavior. I like assessing character. If equally productive and lucrative, I always want to choose the easy path over the hard path. And believe me, you can't believe how many people don't know how and don't do this every day. I don't have to be the smartest or the most important, but I always want to team up with the winners. I want to win, but I want to win the right way, because I believe life's long, and I'm playing for a long, lucrative career, a long, lucrative life, not just a few sparky moments. I believe that work is work. If it was play, I would look and feel like the Caribbean. It's work, it's supposed to be difficult, and I'm not afraid of hard work. I think simple is easier. Shorter is better, and time is precious. Unlimited love, limited time. I care about all of you and everything you care about, but I only got limited time to deal with it, so you've got to ration. I prefer clear, direct, and robust communication, straight talk. Subject, verb, full stop. Your horse won, strike 3. I prefer blue, no ambiguity, more productivity. And I really, really, truly, truly believe that in general, as a rule, people gravitate to invest in and invest with people who are most comfortable with themselves and what they do. Integrity and authenticity matter. What am I less good at? Well, I don't like doing things because it's what's done. I don't like people who behave like they can't be bothered. I don't like process and repetition unless it's critical and productive. I don't easily accommodate late, lazy, sleepy, and lethargic very well. I have limited patience for the long story. Don't start with Genesis. Please, just go right to the point. And while I'm not happy or particularly proud of it, and I try to get better, I'm not as good as a listener as I am as a speaker or storyteller. However, I like to think that's because of my enthusiasm and not because I'm rude. I'd encourage you to give a lot of time and attention and thought to what you're good at and what you enjoy, and recognize and be honest with what you're less good at, and ignore this at your peril and pain. And if you're confused or unsure or you can't figure it out, phone a friend. Find yourself, know yourself, be yourself, know your magic, stick to, refine, shape, grow, and use that magic. You'll find situations change, market environments change, people dynamics change, but I believe that the fundamental skills and truths that you'll need to rely upon to negotiate change and to negotiate that trickiness and to be successful, those really will change. Those same things that you're learning, if you take an honest appraisal of who you are, what you're good at, what you're not good at. Surround yourself with people that might be better at that, can teach you, grow you, help you, stretch you. You will be successful, and you can easily negotiate the stuff that's going on. How's this translated into what Tristan is in our slice of success? I think we've decided to try to refine and grow our special brand of magic. We built an intentional, reinforced culture of aspiration and achievement. I think we're really comfortable with what we know and what we don't know, and we're not afraid to admit it and act as such. We prefer easier. Something I tell clients all the time, we're trying to make real estate private equity as boring as possible. Why wouldn't you? Why wouldn't you do the boring thing and make a lot of money rather than do the hard thing and make a little money? We believe we're excellent investors, but what we really pride ourselves in is being exceptional risk managers and continue to train ourselves to spot, reduce, and manage risk as well as we manage deals and assets. We know what's in our DNA. That's the important part. You've got to know who you are. So why am I jabbering on about this? Because, to be cliche, nothing is as constant as change. All right, we know that, you feel it, but we don't think about it actively every day. And today, with the speed of technology and the resultant dissemination of information that flows around the world and the interconnectedness of global capital markets, everything's changing faster than it ever did before. Okay, so I'm finally getting to the points Robin and Richard really wanted me to talk about. Our industry. The European real estate investment industry is about 20 years old. It really started as a pan-European industry at the birth of the euro, but it's changed at least 3 major times in its young life. And I'm going to go back to doing what I said you shouldn't do. At Genesis, 20 years ago, the industry was dominated by hunter-gatherers, agent-led investment activity and volume. The broker was king, and the institutional insurance company or pension fund portfolio manager was the gatekeeper. I can hear some of you, in the back here that can read the speech bubble, those of you in the agent community going, the good old days. Yeah. There was little co-investment or alignment of interest between investor and client, and most investment was focused on home markets, not abroad, barely multi-country, and certainly not pan-European. Business took place at high fee levels, sometimes usurious, you remember those days. Markets were cloudy, opaque, and information, who you knew, was a huge competitive advantage. In the Middle Ages, after Genesis but before the global financial crisis, this was the age of the American banks, the global capital firms, and foreign direct investment, where previously domestically focused investing became pan-European, and foreign investment programs became global investment initiatives, where size and global reach mattered, and the world was divided into breezers, scourers, and sharpshooters. Co-investment, or the sizable appearance of the house co-invest alongside its clients, was now necessary, where big in brand mattered more than results, or at least just as much, where there were more definitions of the new normal to describe the falling knife of the global economy than one could shake a stick at, where information started to flow, and there was more market transparency, and it started to become more important to know what you did with the information you got rather than where you got the information and who you knew. But unfortunately, it was also the place where 2 men, a dog, and a small basket of cash could IPO themselves on the AIM market, call themselves elite manager, and start attracting capital. But then the rain started, and the storm came, and it didn't stop for a long time. And it cleared the land of many of the global players. And what emerged is what we have now. Fewer managers collecting more capital, a few big dominant global players and a lot of specialists, and what I would characterize as death in the middle. If you're not a specialist or a global player, you have to ask yourself what you're really doing and if you're going to get capital. More prudent investors and lenders, at least for now, because as an aside, I believe that institutional memory is short and institutional justice doesn't exist. And what I mean by this is that the same people that made mistakes in the last cycle from investors who lost a bunch of money, changed their business card, showed up again, and get capital again. It hasn't happened in the cycle, it does. And let me just admit, I'm bitter. I'm a 6'10" black guy. I can't do that. I mean, I'm pretty sure if I took your money and burnt it out the window, you're going to remember it is. I tell clients all the time, they say, what should I really rely on? I said, well, you've underwritten the whole company, et cetera, et cetera. And I said, but if you're looking for me in Europe, I'm probably 2 phone calls away. Like, have you seen that big guy? Like, 2 phone calls, you'll find me. So I'm bitter, right? So, but that's what happened there. A market situation with more prudent investors and lenders, more regulation, higher costs and barriers to entry for new manager proliferation. For the time being, more scrutiny on track record, pedigree, performance, longevity of team, and consistency of mission. More sources and destinations of capital and more product types and destinations considered institutional and investable than ever before. All coupled with ever more uncertainty in fast-moving, changeable, shallow, and unstable capital and property markets. So what are the headwinds? I mean, you name them: Brexit, Frexit, the French elections, Italian banking ills, German elections, the US presidency, the Chinese economic slowdown, oil prices, North Korea, China, Russia, interest rates, Scottish devolution, again. Clients ask me all the time, how do you do this? I mean, how do you make sense of these markets and invest in the midst of all this? Why should I invest here now? And I try to offer them this advice and perspective. I say, the end of the world's going to take care of itself. You really don't have to worry about that. I'm betting against Armageddon, and moreover, if I'm wrong, if it's the end of the world, and we experience that, I bet you're not going to blame me for my last trade. I said, in fact, I think you're going to be much more interested in Do I have room in the shelter next to me? And am I going to share that squirrel that I just caught that I'm barbecuing for dinner? I said, that's the reality. So our job, what you pay us for, is to figure out what to do if the world isn't actually ending. And let's face it, the European marketplace has become the global capital of people's predictions for its imminent demise. It hasn't failed us yet, and it isn't likely to now either. We've seen most of this before, the lurching towards crises and the follow-up of a slow, messy recovery, and we're at it again. Want proof? How far back do you want to go? Asian flu, Russian debt crisis, tech bubble, Cyprus, Greece, the pigs countries, GFC, and now Brexit and Frexit. We're still here. Europe is not sledged off into the Mediterranean as so often predicted by Fox News. On the plus side, Europe still looks less fully priced than the US and Asia. But for the US president's stimulus packaging, trying to cut the corporate tax rate to 15% and spending $1 trillion or $2 trillion on infrastructure, Europe would be, should be, and is, the more interesting play. Moreover, what's interesting about the European marketplace from my perspective is that the headwinds in Europe are creating two-way traffic. Difference of opinion and sentiment and two-way traffic, I like it. That friction, the difference between buyers and sellers and the difference in price and your perception of the marketplace portends good things and is a very healthy precedent for lucrative investing. When I get right down to sort of the nitty-gritty, there's two more things. The two spreads, proving to me it's still worth our time and our clients' time to invest in Europe. That's the spread between the cost of an impaired asset and the value that significant, large, duration and yield-hungry investors will pay you for a repaired asset. Cost of impaired asset, value of repaired. What it means is there's still profit in manufacturing from moving it from A to B. So if you find it and it's institutional but it's broken and you fix it, you can get well paid for it. And that's the real acid test for me that Europe still makes sense. The second thing is, and this is wind in the sails, is the spread between what you can buy an asset for, the yield that you can pay for the asset, and what you can finance it for on a long-term fixed rate basis. I'm not saying that we're spread betting or spread investing, but if you're doing the first that I talked about, and you're manufacturing, and you can get the wind of the sails of effectively zero interest rates, zero real rates and almost zero nominal rates, it allows you to deleverage or de-risk your path to your targeted return, and that's no bad thing, and it's certainly different than other points in the cycle over the last 20 years. When you couple all of this, that most major investors around the world, as I said, are starving for duration and yield, that they can't find the income and yield to match their obligations in their pension plan, the corporates, et cetera, in equity and fixed income, they're all increasing their allocation to alternatives, to private equity, and to real estate. They need more real estate exposure. They need more of what we have, and they tell us every day. So is this potentially lucrative? Is it an opportunity? Or is it scary? Is it time to run away? Or is it just plain tricky? Just maybe it's exactly what we practice and prepared for, the opportunity to differentiate oneself. That time where all the hard work, daring, preparation, conviction just might allow you to eliminate the ephemeral gap between you and remarkable. Yeah, it's tricky. Life's tricky. Stay in your magic. Thank you.
Great, thanks, Rick. Well, I like the way you did that and made it personal, as you say. It made it quite different to many presentations that I guess folk in the room go to. Seeing as you made it personal, I've got a couple of questions that I would like to ask, just to give folk out here sort of an extra perspective on perhaps where you came from before coming to London to set up your companies.
Careful.
And I know a lot of stories about Rick, trust me.
It's bigger than you, Robert.
No, it's never put me off. And then we'll obviously get on to some real estate questions, and then when the panel comes up, we'll cover some of the questions that folk in the audience have already given me. Bear with us, and hopefully we'll get the answers that you want. Just on the personal thing, Rick, all those years back, you told me about life before coming to London, what you were doing in the States as a young guy, I guess, out of college. I think it does tell people a little bit about your mindset and how you have succeeded without being overly flattering. What was that early life like for you in the States, that job that you took in banking? And just tell us a little bit about the helicopter. I love this story. Listen to this.
I'm not sure that's too long a story to tell, but I'll try to take the brief version. I think the point that you're saying is that, without knowing it, and it's part of what I was referencing in my comments, is that I found myself or put myself in situations that made me a lot more comfortable in places where I was different or there was, some strangeness. And so walking in, or even when I came over here 20 years ago and I showed up, the first reactions were like, "Oh, that's lovely. You're a Yank, right? Like, when will you be going back?" Right? Like, I mean, it really was. And then a couple of years later, you'd be like, "I have $5 billion under management." Like, $5 billion? Really? How did that happen? Right, so the helicopter story is I was a banker in a Boston bank, and right out of rotation, I was assigned the most northern territory in the New England Banks region. So that was Maine, Vermont, New Hampshire, the northern New Hampshire. Old industrial companies, people that make brands like Timberland boots, Gorham fire extinguishers, et cetera. I mean, generational firms that had been passed on from, generation to generation. And that was about a 5 or 6 hour drive to go and see a client or prospects every time. So the bank said, well, we have a helicopter, so you can use the helicopter because it would just be inefficient for you to drive up there all the time. Now, the only other people that used the helicopter were the chief executive and the chairman, and me, right, the 24-year-old. So there's the three of us. So that was a good part, and of course, a bunch of my colleagues were jealous, and I'd be like, macking it, like, yeah, I'm on the copter, like, whatever, I'm going up there. But I would call up to a prospect that I hadn't seen, and I'd be going there. I'd call them, and first I said, do you have a 150-foot by 150-foot sort of area that I could use? And they're like, what do you need that for? I'm like, well, I'm going to fly up in a helicopter. So I'd fly up in the helicopter, land in their car park, and get out. Now, someone asked me, they said, were there a lot of black people in Maine? And I said, when I went to Maine, I'd be doubling the black population. Okay, I mean, so I'm getting out to sell to an industrial company that's been in somebody's family for 4 years why they should bank with someone whose nearest branch is 5 to 6 hours away. I'm a 6'10", skinny, athletic black guy in a suit. They're in overalls and jeans. I mean, once you go through that, I think coming over here to start a business in England with Brits, that's a layup.
Yeah, that's it. That was the story. Thanks, Rick. Yeah. Now, can you just bear with me while I put some questions that have already come in from
Sure.
delegates?
Yeah, can I steal my water?
Yeah, I've actually had a sip of that, so.
I don't want that now.
Sorry about that. Sorry.
No disrespect, but I don't know where you've been.
Sorry. Listen, I think everyone heard what you said about the political risks, Brexit, and you reeled off about 6 or 7 others. I know that people in the room are still wrestling with this very much so, and we have many sort of investment management groups represented here. Brexit, just thinking about Brexit alone, surely though you must have adjusted your business somewhat to some of these political risks. I don't know whether it be the way that you structure your deals. Is it that you're placing less emphasis on the UK and looking towards other markets in Europe?
Like many of those market events that we talked about, you've got to look at it and you've got to look at each scenario and say, in that scenario, what's likely to happen in the downside to value and what would I do about it? And I think the things that we invest in are things that we're comfortable if institutional demand or appetite for what we've invested in dried up for a little while or a long while, how do we feel about it? Is it that we're going to, in our downside, deliver single-digit returns or a massive loss of equity? So that's on the negative side when we're looking at those things, and I think it's not dissimilar to how we look at all the other things. Like when we're looking at France now, when we looked at the Italian opportunity, going up into the Renzi vote, it was the same thing. On the positive side, what I referred to earlier is there's a difference of opinion in pricing. And so we're looking for anomalies in pricing. Not anomalies versus yesterday's price, but anomalies versus the long-term average of pricing. And we're saying, look, I think this is oversold. Yeah. Or someone is a motivated seller because they need to get out in a market that's not transacting well, and we could buy this at a different price. There's a lot of factors that go into it. Sometimes we're buying at something and we're saying, we're clipping so much cash along the way, we're de-risking our equity position. So there's a lot of reasons and ways we look at it. I'm reticent to call what's going to happen anywhere because I was 0 for 2 in the last couple of years because I didn't see Brexit, didn't believe it was going to happen, and I didn't believe that His Highness the President Trump was going to be President of the United States. So I don't want to be bold enough to call this, but it feels like each day that goes on that we're going to muddle through into some kind of compromise that allows the country to feel like it got independence from the European Union, but with a lot of the same rules. But I don't think we're going to see a major fracturing where people redline investing in the UK or in Europe anytime soon. I just think it's too important a marketplace with 350 million people. And you've got to remember that Europe, over and above being an interesting destination for capital, has really been a major social experiment. We need a cohesive Europe. The world needs a cohesive Europe because of what's happened over the last 100 years socially. Wars, tension, etc. And I think that's going to continue to drive the United States, China, IMF, etc., to figure out like how everyone gets in the room, muddles through, doesn't like each other, but makes it work. Kind of like Christmas or Thanksgiving. Right? Like, it's like
Right.
same thing. You don't have to like everyone, you just have to be with them for a while.
Now, also, I heard what you said. No one ever gets up on stage to say, hey, this is where we need to invest. This is the best opportunity. But he knows I'm going to ask it anyway.
I'm not going to do
He's
it
not
here
gonna get away
either.
with that. But listen, I did a little bit of research, just see what you have been investing in. And I don't know if this is for the opportunistic series or Core Plus. You can let us know. Recently, correct me if I'm wrong, there's been Dublin rental developments, Hamburg logistics, Stockholm shopping centre, I believe. You bought some retail parks in the UK recently from Brockton, and something down in Plymouth, I think, developing a department store or something like that. That looks to me like a very eclectic mix. Do you actually have any hot spots in mind, or is this just random situations coming that fit the ethos that you described? Is it all luck, is basically what I'm asking.
It's very artful questioning, but I'm still not going to answer the question. First, we're investing on behalf of two funds. One is a Core Plus fund and one is an opportunistic fund. So depending on what the asset is, where it is, what the strategy is, it could be there. So it's probably a little less eclectic when you separate it by funds. And there's very different reasons. Some of them were long walled income producing purchases with, we think, long-term upside potential. And others are in the path of growth. Like when you talk about Ireland and PRS, rents are growing at 10% year over year, such that the Irish government is starting to put in some rental controls. I mean, that makes all the sense in the world. My biggest concern is, can we find enough stuff before the pricing changes? But there's no one flavor, one color. We're doing a bunch of different things for very different reasons.
Yeah, well, let me try it this way. Is there anything that you...
It's not my first rodeo.
Yeah. It's cute. Something's got to land. What about, there must be something where you have a red line, just something that you said to the teams, talented, that just leave it alone. That is not for us right now. I can tell you that is going to be a bad call.
You're perhaps overlooking some of the biggest picture. Like, we only invest in, the deepest, more robust real estate and capital markets in Western and Central Europe. So we don't do anything in Eastern Europe. We haven't,
Right.
we don't do Russia, we don't do Ukraine, we don't do the smaller countries even in the EU because we think that they're less investable. Because, our client base are large institutions and corporate pension plans and family offices that are large enough to act like institutions. So we need things that are investable, in relatively significant size and scale. The things that we've redlined in Europe is largely about like what the size of the investment potential is. But we haven't done much or anything in Portugal. There's a couple handfuls of things to do in Portugal. I mean, if you're not a retail investor and teamed up with somebody.
Yeah, well, Lone Star just
really
bought that
good
bank. Did you see that? 75% of a Portuguese bank. So there's stuff there.
There you go. I just need to buy a bank.
Yeah.
There you go.
You mentioned the Core Plus vehicle. So everyone's aware that life started out more for the Episo series, opportunistic, and then you moved into sort of Core Plus. And as I understand it, that latest Core Plus vehicle has sort of a semi-open-ended structure to it, or at least characteristics of an open-ended fund.
Yeah, so let me correct something. First, our first funds were Core Plus.
Oh, they were Core Plus.
So CCP 5, Curzon Capital Partners 5, is the fifth fund.
Okay.
We have a 17-year 5-fund track record in Core Plus.
Yeah.
We moved into the opportunistic funds in 2004. Yeah, the new fund is a perpetual structure, and what we really did is that clients were saying, hey, look, we've been investing with you for a long time, we like it. You used to come to us every 3 years, then every 2 years. You're kind of collecting and investing the capital pretty efficiently, and you're kind of in every year. Can we do the same thing, but can you put it in a different wrapper? Can you put it in a wrapper where we could continue to invest with you and you can recycle it, and I don't have to go back into committee every year to do it?
Is that for mainly the larger LPs or
It's
the small?
for
It's for
anyone.
everybody.
Yeah.
So you're saying it was investor-led, really?
It was investor counseled anyway. What I would say is it's a hybrid fund. I mean, it's effectively, I don't like to use the O word and call it open-ended fund because of liquidity issues, but we're very honest with our clients. We say, look, in a real estate product, liquidity at best is, there's partial liquidity. You're never going to have full transparent liquidity. And so we've got open-ended features where we can continue to invest the capital forever. And then we've got some closed-end features in there so that they're in a fund for a while. They have the ability after a lockout period to ask for redemptions. They know what our priorities are: protect the fund and ongoing investment, not redeemers. But then there's also some check-in dates in which we may decide we convert the perpetual fund into a closed-end feature and liquidate it over 5 years hence.
Yep.
So they feel like they've got the best of both worlds, but we've cured the problem of coming back in for capital. We might have reduced my requirement to be Mr. Bojangles and on the road all the time. That's what my daughters call me, Mr. Bojangles. And you're going jangling, you sing a song, pass the hat, collect some capital, and then see you on Saturday. But so that's what we're really trying to accomplish. And
I don't know if this is cynical or not, but a question that came in from a delegate is just your assessment on the chances of actually making 15% returns. So if you were to go on the road, and there's many people here promoting value add funds, whether it's UK only or pan-European, is 15% viable, would you say, in this market?
I think it's an interesting question. So yes, I do, but I think it's getting increasingly more difficult for a couple of reasons. So you remember that in 2014 we raised a PISO 3, and then we invested it really quickly, and I think very well. And then we were in a hurry to get back to market, and we raised a PISO 4 because I wanted to have the capital now and be where we are, half to 60% invested. Because I think we're in a marketplace that if we don't get more disruption and dislocation, or if we don't get more above trend growth, it's going to be really hard to make 15% real without taking a lot more risk. And I think that's what we've been counseling clients. We're saying, look, things could change. We could get to the point where Europe's growing again and there's above trend growth, and then you can make that. Rents are rising, et cetera. You can also get there that there's more dislocation. Some of those headwinds become bigger, and there's more things smashing into each other, and you get windfall profits. But if we don't have one of those two, and we stay somewhere in stasis with rising interest rates, you got to think about how many times in the last 20 or 25 years it was possible to book 15% real. 15% real. It's not 15% nominal, it's 15 real. That's a reason that we've gotten a lot of interest in our Core Plus fund, because I think some clients are saying, I like investing with you in the opportunistic, but I wouldn't mind downshifting right now and taking a little bit of risk off the table, but still availing ourselves of the European opportunity.
And to be fair, we've seen other investment managers do the same, right, actually? Okay,
Yeah.
good. Right, here's, I'm going to really take a risk here. Here's a highly, highly impertinent question. Rick, you've talked about life in business and how long you've been doing this for. How to phrase it? Do investors nowadays, have they got to the stage where they ask you about, is there succession planning? Tristan, do you have a year in your mind as to sort of an exit for you and whether you go off and do something else, or what's the plan?
Not many clients ask it, but a few do. But I think it's a responsibility for anyone that runs a firm. If you're not thinking succession the day you take the job, you're not doing your job well. So with that, I'm not going to tell you the details, but we do have a succession plan at Tristan. We know how we'll run the company after and when I go. And you notice I just didn't answer your question. And we're working on that. We're working on developing the skills, readiness, thought process, among the senior partnership and the next level. But none of that's taking place now because, well, one, I ain't going anywhere. So, and we know that. So I don't have a plan to go anywhere. There's not a particular year. I asked some of my senior partners, I said, look, if I got hit by a bus or I left or I just decided to play a lot more golf and never came back in on a Monday, what do you think your preparedness is to sort of run the company there? And we've had a pretty honest appraisal of sort of where we are, because I just think it's good business. So yeah, we're planning on it, but we're not going to get rid of me anytime soon.
Okay, seeing as that's the case, final two questions before we get the panel.
Hard.
Yeah, before we get the panel up here. There's two sort of things that I heard about you in the market. You'll have to correct me if I'm wrong. It kind of leads back to the personal nature of your TED-style talk. First up, your personal routine. Again, this might be completely wrong. I was told what you do nowadays is you come from your home in North London, you run into the office. Maybe someone's joking with me. You run into the office, get there for, 6 a.m., you look at the deal folders, you genuinely read the things, and you put them back on the desk of the relevant person with all the annotations and questions, right? And then you go back and do the school run, and then you sort of restart the day.
No, bad information. I was going to just say to some of my team, do you think that's true?
Is that true?
No.
That's not true.
No, so first, I'm a sprinter, not a long-distance runner, so I'm not running into work anywhere. Anyway, so I think they were joking with you, but I think our team does know that, there's no real, I mean this in the bad way, there's no real end to the workday. So they'll see me leave at 5 o'clock, but that doesn't mean that I'm not paying attention, I'm not reading things, et cetera, and I think they feel like
I can check this, there's about 5
well, that's what I'm saying it to them. Like, they know, we've talked about this. They know, because I've said to them, I said, look, when you're staying there till midnight and you see me leaving at 6, don't be confused, all right? I mean, I appreciate what you're doing. 2, it's not like my day's over. But I do believe very much, and so my world has always been sort of family, community, and work. And so whether it's boards I'm on, trying to be around for my daughters, et cetera, I mix those things up. So I will get home to do something with them for 2 hours, but then I'm back working for a few hours. So if they're working on something, they send it to me at 8 or 9 o'clock, I'm reading it that night. On the weekends, they get responses to the things they send me. I think sometimes it surprises me, like, why is he looking at this at 11 o'clock?
Yeah.
Like, surprise, surprise. Yeah. But I think you have to do that if you're going to help people understand that what they're doing, the sacrifices they make, being there at 11 o'clock at midnight, is valuable, that you're actually paying attention and that you read the stuff. So I'm not running in, but I do the school run. But it's pretty easy. We live on the same street as the school, so.
Yeah. Very quickly.
Who says I'm dumb, right?
Deal tactics. I once heard that a few years ago. You had a very large exit of a portfolio in Europe, right? And the potential buyer, you were on a conference call, and they named the price. We're willing to pay this amount for this, and you guys were very pleasantly surprised by the number. And I think I got the impression that people on the call just wanted to bite the hand off and say, yep, that's great, let's do that and move to legals. And somebody pressed mute and said, hey, let's pretend that that's a really offensive offer, right? And you hold out and you get a bigger number.
So
It's
partially true. So we were selling a big portfolio, and we had great bids for it by a certain group. They should remain nameless, but they're no longer around, so it was probably the wrong price.
Right.
The cover bids were literally 100 million below it. I mean, this was order of magnitude of 850 million, and the cover bids were 750. And I knew that the cover bids were by thoughtful colleagues that I knew, and I knew that was probably a realistic price. So let's say that they bid 850, and they had the money, they were credible, et cetera. We're on the conference call, and literally they called up in the penultimate before we were going to ink, giving them exclusivity, and they said, look, there's been an analyst mistake. Of course, always blame it on the analyst. Like, how wrong is that, guys, right? And we've caught an error in our model, and we've got to reduce our price by 10 million. So we put them on mute and said, when we get, oh, just a second, because it's very serious. We picked you because your price was good. Yeah. We put it on mute and we said, okay, now for the next 10 minutes, we have to act like we're so angry and we're going to pull the deal from them, and we can't believe this is impossible, but hold on to this bid at any cost. So that's what it was. Okay. It was like we said, I can't believe you. I can't believe it. Like, this is ridiculous. No one does business like this. But let us think about it. Okay, right, 840, we'll take the deal. Yeah, we'll take the deal. So that's what it was.
You can Google that, 840, and find out who that was, the counterparty. Okay, I'm going to save a question for the panel session. It's a very specific one about catch-ups, actually, in Tristan funds. But we'll hold that and we'll come back to it. Good. Can I ask the gentlemen to take their seats? Rick, you're on the far side. In the meantime, why not give Rick a customary warm round of applause? Thank you. Let's get some other voices into the mix. You can see, obviously, the names of the gentlemen on the stage. But let's just kick off, first of all. Thomas Wels of UBS, thank you for hosting, by the way. From your perspective, what are the sort of the things that are uppermost in your mind at the moment?
If I look into the international flows, when we go to institutional clients in the Middle East, in Japan, less so in the US, also in Europe, the interest rate scenario is still the same. And we are talking about zero real interest rates or negative real interest rates, which is really disturbing. This said, pension funds in Japan, life insurance companies globally, they are desperate. So every year, 10% of their fixed income portfolio is rolling off. They have to replace it. How do you replace it? Volatile equity markets, higher risk fixed income, like emerging market debt. Yeah. Where do you put your money? You can go further up the risk curve, going for value add because somebody out there is promising 10 to 15? Or do you go for yield, which is 350 basis points over risk-free rate? And there's $1 trillion out there which has to be invested. We have a big business in in Japan. We're the biggest REIT manager in Japan together with Mitsubishi, so I'm out there every quarter. The 10 biggest pension funds in Japan represent 4 trillion of assets under management, and they are not invested in real estate today. Parliamentary decision 2 years ago, go into alternatives. 10% of that is real estate, but they don't go into already overvalued real estate in Japan. So where do they go? 400 billion of equity is going to reach the US or Europe in the next 10 years. Is that disturbing? Yes, it is disturbing because they're late in the game. So the interest rate scenarios in Japan, we believe, is not going to change. China is a little bit an oddball because it's political decisions which make the money move or stop moving. So whether it's 400 billion from Japan and another 400 billion from China in 5 transactions, in 10 transactions, it's just not predictable. And the Middle East, money out, money in because of the oil price. The $50 is the trigger. Everything above $50 is going to lead to further inflows into real estate and the like. And below 50, it's going to hit equities and fixed income because it can move out. The moment oil price goes up again, it's going into real estate again. This tap is going to be switched on and switched off depending on oil price. So where do we stand today? There's just too much money around which has to be employed globally. And the big difference is, compared to the last cycle, it's much less debt financed, which is a good thing. But there's a certain desperation of getting the money employed, whether it's in 5% core or 10 to 15% value add. So that's a rough scenario of.
Well, it does sound like a rough scenario in a sense, right? I mean, there's loads of money, but there are some potential red flags. The two pools, seeing as you, I don't know if it's right to characterise yourselves as representing the investors. We certainly have plenty of clients looking to put money to work. How do you actually react to that, and what are you counselling at the moment?
So a lot of our clients are pension funds looking, in essence, if they can get a couple of % over government bonds, that's their long-term mission. They can meet their liabilities and keep their pensioners happy. So the big flows, certainly in the UK and in the Eurozone, have been into secure income strategies, so long lease property, social infrastructure strategies, illiquid credit, basically long-term contractual cash flows, often inflation linked. And I think in a low bond yield environment, there's still attractive spreads that you can get there, certainly over investment grade credit and certainly over gilts. So we've probably seen 2 to 4 billion over the last couple of calendar years go into those types of strategies. And pricing has moved, but there's still, I mean, at the same time,
2 billion, did you say?
2 to 4
okay.
billion of commitments. So pricing has moved, but at the same time, bond yields have also fallen, especially post-Brexit. So the argument for investing in those types of asset classes still stands, and we expect that to continue.
Yeah, happy days. Paul Richards.
Yeah, I mean, we're exactly the same dynamic for our clients because it's mostly pension funds. I mean, it's interesting picking up on what Thomas said. A lot of the money which is going into real estate is driven by factors which are not to do with real estate. So, low bond yields, exactly what Paul's been talking about. How do I meet my liabilities? But also at the other end of the spectrum, what I've seen in the last couple of years is because economic growth is sluggish. I mean, economies are growing in the developed world, but it's sluggish. People are not getting, they're not going to get that growth out of the equity market. There'll be the volatility along the way, but there won't be the underlying economic growth. So we're seeing people focusing on strategies where a manager will go out and actually create value by doing something, which goes straight to the kind of things that Rick does. So there's this kind of barbell view of the world developing, particularly for our pension fund type client base. But what we're also seeing, interestingly, is money coming from Japan, Middle East, coming into Europe, looking at just basic core real estate because it's got an income. So not at the long lease kind of stuff because the yield's a bit lower on that, looking at core stuff with maybe a little bit of value add, core plus, because of low bond yields elsewhere in the world. So lots of money coming into real estate driven by things happening elsewhere.
I think those dynamics are likely to last for a while because pension funds are likely to be de-risking for the next 20 to 30 years, and there aren't sufficient bonds out there for them to do that de-risking, so they have to be looking at these alternative asset classes. And to go back to what Rick mentioned earlier, in terms of that means that the exit for good kind of value-add opportunistic managers is likely to stay presumably quite fruitful for a while, because the demand will be there for those well-let, long-lets properties. And so we are also kind of selectively looking in the value-add space, but I'd say the hurdles are somewhat higher than they have been over the past few years, as we're becoming far more selective in picking our spots, I'd say.
Your point, of course, ties in with Rick's idea of manufacturing to core, I think, or institutional quality is more or less what you were saying, Rick. And just a word perhaps on the global capital flows. As Thomas said, there seems to be so much money ready to access real estate, including for Europe. Your fundraising seems to be always in the market fundraising. I'm assuming it's just a walk in the park, therefore, just to get the money into your funds. But have you seen sort of new and fresh sources of capital, or has the LP base stayed more or less the same?
No, I think we've seen a lot of new capital come to the marketplace. So that's been rewarding and intriguing. I think what's even more intriguing is the capital that's on the doorstep, and I think that's what these guys were talking about. Is you see some of the flows coming out of Asia, Japan, et cetera, China, where they over time are going to need to put capital in a very significant way into professionally managed products in real estate because they need duration and yield. We haven't gotten there. But no, we feel like we've gratefully diversified our client base globally by type, et cetera, and that's a pretty good place to be. And part of it is that we do have more regulation, there's less manager proliferation, there's a little bit more scrutiny over who gets capital now. So, we don't get our fair share. It ain't easy. It isn't a walk in the park, but it's not like it was before where two people could have a good idea and raise 500 million.
Yeah.
I hope those days don't come back because, moral hazard's just around the corner.
Jonathan, you're working on structuring transactions. Clients can be sovereign wealth funds, pension funds, I understand too, and maybe family offices. What are you actually seeing from your side of business?
It's really interesting sitting in London as part of a global platform like Dentons that's got the most real estate lawyers of any firm in the world, that you can see the opportunities that are coming from other parts of our business. And in particular, China and the Middle East are the hot points at the moment. And I think for the Chinese investors, it goes more than looking at the economic attractiveness of investing in the UK and Europe. For a lot of the people in decision-making positions in the Chinese investors, they would have studied here, they would have spent time here, and it's that familiarity that in many ways is the starting point for the decision-making process. The economic fundamentals are still there, but when people are making their first foray into the world of indirect real estate, they want to go with something that they know, and they want to go with something that they perceive as being safe, and that will be gateway cities. When I've spoken to my partners in other parts of the world, that's what really is a driving force for those types of investors. And it's a similar thing for the Middle East. The activity levels had dropped off for a bit, but now we're seeing those family offices paying a lot more attention to investing in Europe, and also the types of asset classes that they're investing in are slightly different. So some will be focused on less riskier opportunities, but gone are the days where it was just sort of your offices or your sort of trophy assets. People are looking at other areas, and obviously we've seen a lot of Chinese interest in student accommodation over the last year, and I think that's going to continue from what we've been seeing, but also looking at other areas as well, like logistics and senior living. I think that they're going to be sort of key areas that people are going to be focusing on.
Just as an aside, Thomas and yourself, John, you mentioned Asian capital and China in particular. I don't know if you noticed this, but Hammerson, so borrowing something from the public market, they, as I understand it, they refinanced recently, and there were something like 5 Chinese banks involved in that, and perhaps one from, I think it was Taiwan or Korea. Is that a sign of things to come? And also, are you seeing Asian capital being involved in financing developments?
China's banking system is reaching out globally because they hold significant amounts of US dollar or foreign currency, which must be reemployed. So most well-known Chinese banks now have branches in London, New York, and they test the waters with less risky things like core real estate, together with the Japanese bank. They start with core and then they reach out to developments. We didn't see them in development financing yet. We see Middle Eastern banks trying to play in France. We see Chinese banks playing in Australia. And Australia is one of the biggest, most liquid and closest professional real estate markets to China. So we would probably see them more in these locations. But if we lose people today, we don't lose them to competitors, but basically we lose them to the mortgage department of Chinese banks.
When that happens, should anyone take that as a sign? You talked about the bubble or signs of a bubble earlier. Is that any part of this overall picture?
Well, that does mean that the local banks leave space for foreigners. So there's a situation that the continental European banks are still not well capitalized, though they gave up that space. So Chinese banks probably have more credit power than domestic banks. But yes, the foreign banks are getting the last call and probably doing some business which the local banks with the local knowledge wouldn't do. So there's a certain risk that we start seeing more leverage in developments or riskier situations, which is good, having a bit more competition. I mean, we were looking forward specifically in Australia. So Australia is an oligopoly of 2 banks.
Yeah.
So having a little bit more international competition actually drives down the margins in lending, which our book is leveraged if it is not core funds. When we represent institutional clients up to 50%, somewhere between 40 and 50%. If the locals don't provide adequate leverage, we get it even here in the UK from Germany, but we don't see the Chinese play in the UK for the moment.
Paul, I think you mentioned in the past various signs of potential problems in Europe. Could you describe various pockets that you might see?
You mean apart from just everything that's...
Yeah, I mean, just explain everything that you're seeing that is potentially...
Well, the big thing is uncertainty. Nobody knows what Brexit will look like. Nobody is talking about the German election because they're all talking about the French one. And the answer is, well, I could point to lots of things, but it might be something else. So I don't know. But I think the probably more important question is, so what do you do about that? And it's interesting, I'm working amongst people who come from a real estate background and people who come from a consulting background in our real estate team. The instinct of some of the people who haven't been in real estate is, oh, we should retreat to core, we should retreat to safety. And actually the people in the from a real estate background is, no, we should be looking at taking risks because this is dislocation. This will create an opportunity. It is a risk. You've got to go with people who know what they're doing and can see what the risks are. But it is, I mean, I don't like what's happening, but you take advantage of it and you go and find out what the risks are and you get paid for them. If you want to define what those are, I could tell you today, but next week the answer might be different.
Let's just switch it up a second. There's plenty of people in the room, I think, that are representing established managers, so they'll have their own experiences of raising capital. And there's also people that are representing newer managers, emerging managers, which kind of leads us on to the theme of where is the market going? We talk about open-ended funds, if I could get some views on that, but also fees and terms. I would be interested to know what sort of differences are you seeing in the marketplace today? Maybe Paul and then Jonathan, you could pick up on that.
We're generally in favour of open-ended funds on real estate. I think the key is that the subscription and redemption terms have to be very investor-friendly for the long-term investor. So any open-ended fund that allows that requires the manager to hoard cash or is going to be a drag on returns and force the manager to put assets to work. Anything that forces them to have to sell assets quickly in redemptions is a bad thing. So we've seen a lot of improvement in open-end fund terms post the financial crisis. I think we're in a much better position today. The headlines that we saw post-Brexit were a very different type of open-ended fund aimed at retail investors, which most of our institutional clients weren't in. So I think, on the whole, open-ended funds serve a good purpose for long-term institutional investors and allow them to keep hold of really good quality real estate and not have to sell them in kind of 7 or 8 years just because there's a kind of an arbitrary end to the life. In terms of fees, I think we have seen a big reduction in fees over the last kind of 10 years or so, and we've been working with managers to help improve the outcomes for our clients on that front, and certainly seen a lot of movement in the value-add and opportunistic fund space in terms of the management fees and the the structure of the carries. And one of the observations I would make is just on the European opportunistic or value add side. The market norm here, in our view, is to have no catch-up. And that's quite different to the US, where there's a 50% catch-up model, and that's the market norm.
Yeah.
Now, the thing that frustrates me is that the managers that are able to raise capital from largely US LPs are able to get away with a 50% catch-up because they can. And there's a small subset of managers that still do that. A lot of managers have moved to a low pref and no catch-up, which is, I think, is the market standard in which we view quite positively.
I was just saying that, with respect to our perspective on open-ended funds, and I think we have to be careful about what we call them. We've been choosing to say perpetual funds because I think what people thought of open-ended funds were, as Paul said, they were designed for retail investors, and what we found is that in moments of crisis, all the retail investors want to go out the doors and the windows, and you don't have liquidity to do it. And so what happens is the structure of the product ends up being reverse engineered for the wrong type of investor and the wrong type of activity at the exact wrong moment. I think new products are being created that, in consultation with clients that aren't doing that protect the fund itself, don't have too much cash and liquidity. But my bigger perspective is that, but for the headwinds and the macroeconomic turmoil in Europe, should be or would be more advanced in having more perpetual open-ended products. If you look at the US, there's $205 billion of Odyssey funds. We're going to get there eventually. We have to, right? Because just like in equities with ETFs, the backbone of our investment menu is going to be something where you can get consistent long-term returns from a place. And so as this 20-year-old industry matures, we're going to move to that place. What we're doing is we think we're satisfying a client need. It's very temporal, but we're also, a step on the path to where the industry is going to go over the intermediate and long term, which is there's still going to be value-add investing, there'll be core plus investing, et cetera, but there'll be a big swath of core and perhaps core plus open-ended perpetual life investing because clients need it.
Do you remember that I mentioned there was a very specific question from delegates about Tristan funds? Do they actually have a catch-up?
We don't. We never have. So I think fundamentally we believe that, we've had a hard pref and that we get promoted over the pref, and, we used to have multiple hurdles, but this was negotiated with clients. And it's funny, if you go back to our very beginning with one Dutch client, APG, and one US client, CalPERS, and they said, I don't mind if you get paid, and you get paid a lot on the back end after I've made my money. And we said that works for us. That seems like it makes sense. So none of our products have ever had a catch-up, but we get paid pretty well if we do the job.
Jonathan, question here to keep the fund administrators happy and also some fund structuring lawyers. Brexit, has that affected the way people are structuring their real estate investments or the funds? Is it still very much Jersey? Is it some other jurisdiction that's now being talked about?
Before coming to that, just picking up on the open-ended side of things, I think that Rick's right. Seems to be ahead of the curve in that there's going to be more different structures are going to come down the track over the next few years. As on the back of the ARIF consultation that was just finalised at the end of last week, there's going to be more communication, and people are going to look at ways in which people can really be served how they get what they want to out of those types of funds. So I think that's something that we're going to see more of, and it's the fact that it's on the radar of some of the biggest and best fund managers, shows that it's going to happen. And we've got to remember that this is a relatively infant industry, that we are lagging behind what happens in the States, and we will get that. So I don't really see that Brexit has changed too much. I think there's obviously the uncertainty around the passport, and the funds that I've been working on, the manager is always looking to be to be within the directive, to be within the scope of the directive, and not to rely on the national private placement regime for its marketing, just because of the uncertainty that surrounds what will happen post-Brexit. So I think that hasn't changed, and I think that probably, I'm not sure that we would, when we leave the EU finally, I'm not sure that we would necessarily change too much of the legislation that we've got, because as the UK we want to have equivalency in order to take the benefits of that. And in terms of jurisdictions, I see Luxembourg and Jersey as still being the two main jurisdictions for real estate platforms. I think for European structures, Luxembourg more so, and both Luxembourg and Jersey are sort of competing in the same space, and they've both got a large amount of very, very good administrators. They've got the infrastructure. So a lot of the time it will just go down with what the client knows and where they've got a presence at the moment to do their next fund. So I see those two jurisdictions as being the most important ones, and then sort of coming a bit further back in the queue would be the Irish market and then Netherlands.
Just a footnote on AFM, seeing as you mentioned it, and marketing. If you're a North American real estate investment manager looking to top up a fundraise for an American fund with European investors, they're not really going down the AFM route, are they? They're kind of going more of the private
placement regime.
Right.
Yeah.
Is that still the case?
Yeah, I mean, I've not really seen that much activity from those guys anyway, because I think that the certainly from my own perspective, I think the US market in Europe is more focused on infrastructure type assets in Europe, so they're going down that route, and then they're mainly focused internally anyway from the clients that we've got. They're focused on the US markets.
I must ask this, it's been causing quite a lot of gossip in a way in the market. The law firms in Europe at the moment, we see things happening with Nabarro's, which obviously had a very strong real estate practice, now merging, and then we see KWM with obviously also a number of strong individuals working in fund structuring, etc. Those guys seem to have imploded, if that's not an exaggeration. What actually is going on with the law firms in terms of their real estate practices? Have they got the model wrong? Should they have outsourced basic leasing work? What actually is the position?
I'll declare an interest in that. I used to work at Nabarro until a few
there are some Nabarro people here too.
A few months ago, and I think they were two completely separate cases. The KWM case and the Nabarro case. Nabarro are merging with CMS and Olswang, and that goes live at the start of next month. And I think it really comes back to something that Rick mentioned in his talk about globalization. Law firms have to change to deliver what their clients want. And in this world, it's all about being global. It's all about being available to service your clients at all times. And it's all about being in parts of the world where they are and where they want to do deals. And so gone are the days where you can focus just on one particular market and one particular sector. You have to diversify. And that's why we've seen over the last 5 years American law firms come into the UK and not just set up a satellite office for their New York office or their Atlanta office or something like that, but taking the best lawyers from established city practices and building a standalone proper platform in London because their clients demand that they are in this location. And that's really what's happening throughout the legal market. There's increased consolidation as people look to get that scale on a global basis. And there's also the increased demand, and again, something that Rick talked about, is to embrace technology and to make things that have historically been difficult simpler. And that means investing in artificial intelligence and working with people who develop products. And that's something that lawyers, and probably are some lawyers in the room, we're not very good at taking all of that on board, because we like to have our quill, ink and parchment and write things down, and we have to move with the times, because that's really the next generation of lawyer is going to be very, very tech savvy. So I think that law firms are changing. I think you're right. I think that KWM is a sad case, and particularly sad for those people that lost their jobs. It is a people business as well, and particularly sad that a brand that was so strong for very many years has gone. But it does show that law firms need to adapt with the times and not rest on laurels.
The two pools representing the consultants I've got to take this opportunity to something also a little bit controversial. What is your analysis at the moment of this development I'm reading about? The FCA seems to be implying, or maybe that there's a stronger word to use, that consultants are in a sort of a monopolistic scenario, particularly in the UK. Maybe it's further afield, and there may be an investigation or something of that nature going on. What actually are you seeing in this field, and is it also to do with perceived conflicts of interest, especially when consultants launch their own investment management platform? But Paul, if you could have a stab at that controversial
You're going to
question.
pass the buck to you, or are you going to pass it to me?
You'll be desperate to answer that question.
So it certainly doesn't feel like a monopoly in the sense that we feel we feel highly accountable,
This is the market.
under pressure to deliver for our clients, and all the good things that you would expect. So the FSA investigation was of the asset management community, and it was one of the highlights from that was the impact of consultants and the kind of market concentration within consultants. And I think the findings of the FCA report were actually all very sensible and made sense. And if you think about the industry of saving for that end pensioner, which is what our industry is about, that industry is a high fee, high profit margin, high salary industry. It's right that is questioned because we're ultimately saving for the end investor. And so I think a lot of those points were right. I think the three large consultants, ourselves, Mercer and Aon, have submitted something to the FCA, so there's ongoing consultation with them.
Yeah. The response of the combined firms was, frankly, laughable, wasn't it? It said nothing in terms of what you're actually going to do about it.
I think we've said something very clear to the FCA, and we want to be
very clear. Well, what is it? We want to know what it is.
We want to kind of pin that down with the FCA first, but I've probably said enough before. Over to you.
Okay. Listen, let's just give it 5 more minutes, and then please I'll open up the floor to questions in a second. Seeing as you can see, I'm basically touching on every part of the private equity industry. It's now the time to look at the placement agent world. We have placement agents here, certainly in-house capital raisers as well that perhaps have come from that area. Rick, I want to ask you this, because you guys, as far as I understand, have been using placement agents, but the problem obviously is once you become successful, you build up your own client base, and you don't necessarily need their services anymore. So a good placement agent kind of does himself out of a job when it comes to the repeat fund, and so they're constantly, of course, having to look for the next manager. And you already said that the industry is consolidating somewhat, making it very hard for them to find that the next mandate that they think is going to be a winner for them. So is it true that for the Core Plus fund that you have, you're not using a placement agent? What is your view?
We didn't use a placement agent on the Core Plus fund. We felt like we had consulted a lot with clients. We knew what the client appetite was, and we knew that we were off to a pretty good head start. So there really wasn't a need, and it wasn't going to make good economic sense. I think for the placement agents in the room in the industry, I mean, I think it is tough, but so is our job. Like I said before, life's tricky, right?
So sympathy.
It is. No, but I mean, I think you're right. I think that if you're working with a good manager and you do things a couple of times, and they have the thought process that they're going to continue to do some things inside their own shop, then you're right. You're probably working yourself, a little bit out of work or business on that product. But if you've got a good relationship with the manager, you should have the ability to talk to them about what else they're doing over time. We have 9 funds in our entire existence, and we've probably used placement agents on 4. You think the market's cloudy, there's stuff going on inside your organization, you're raising 2 funds at a time, you want to expand your team, your capability with an expert partner, that makes really good sense to use a placement agent. It doesn't make sense to use a placement agent if you're pretty capable, at the sales pitch, you've covered a lot, you know where the clients are coming from. Because, as I joke, nobody wants a situation where you hire a placement agent, you say ta, they say ta, you say Tristan, and you do the next 2 hours, right? I mean, if you've got the ability to do it, they don't want to be on the assignment anyway. And frankly, you're never going to make an economic deal that's going to be lucrative enough for them to be on it.
Okay, thank you. Thomas, as we begin to wrap up our section, longer term, the prospects for real estate investment managers in Europe, is it going to look the same in 10 years' time?
I think it's basically driven by the structure of the investors community. We see UK pension funds consolidating. We see a concentration in the Netherlands. The large pension funds in Germany are growing much faster than the smaller ones. Yeah. So I think we are going to be confronted with fewer and fewer clients if you are not since we are really
Fewer and larger clients.
fewer and larger clients. So the ticket we probably sold 10 years ago was 10 million, and 10 years later, a PGGM or one of the large Germans would say, "Don't waste my time with the tenner. Come back with a good investment idea. I can only do the due diligence if the investment is 100. And at the same time, I don't want to be more than 10% of the fund." This,
Yeah.
and we are talking China. So we have to come up with a 1 billion idea to bring it to 10 global clients to be in business. And this is not only happening in China, this is happening globally. I mean, the US pension fund schemes, the big boys, the CalPERS and CalSTRS, they're NISTers, probably the top 10 the top 15 cover 500 billion assets under management.
Sure. Yeah, I mean,
So-
in the past several years, the last 5 or 6 years, I've been summoned, a polite way of saying it, to Beijing a couple of times.
Yeah.
We weren't marketing to them. I get reverse inquiry, email and phone calls saying, "Will you come to Beijing to meet with so-and-so?" I won't say who the client is. And you sit there, and they're huge, right?
Yeah.
They're-
So we are
and they look
talking
at you
a
and
trillion.
go,
Yeah.
"We like you, we like your track record, we've been following you for years." That's a little scary.
Rick,
They said-
grow a bit.
They-
Grow a bit.
No,
Then we can talk.
They said to me, like, and how did you enjoy the hotel? And they say, "The specific hotel." And I said, "I didn't say where I was staying." They said, "You didn't have to." Like, okay. And that goes beyond being the 6'10" black guy. That's like, they just know where everyone is. Right.
So-
But in the end, what they say to me is that they're like, "We like everything about you, but yeah, you just need to grow a bit."
Yeah.
And we're not going to write a check for 200 million. So like, even if you're $1.5 billion, when you get to 2 billion, come back because we want to do something with you. It's like,
So the second point, we were talking about the open-ended ones. I love open-ended because our firm owns or manages money for 8% of the ODC funds in the
Yeah.
US with 2 vehicles. We have a track record of 35 years. There are only 7 firms in the US who have a 20-year track record. Now there are 25 or 30 firms. So let's not expect that the open-ended fund world in Europe, Lux-based, is going to be very big in the next 10 years. Because at the same time, we are competing against, why Luxembourg? In Germany, we already have an open-ended market. 4 players dominate with Publikumsfonds, each bigger than 5 billion. So the Germans themselves would say, we don't need open-ended, we have it. The Italians like the SGRs, the French are the French. So the consolidation and the creation of an OTC type of solution in Europe is going to last at least the same amount of time. This said, financially, because of the fee situation, I prefer to be in an open-ended world, having large funds available and replicate the US model.
I think the logic is sound, but I'll take the under. Just because I believe in sort of, how cycles are shortening. What was 10 years is 5 years, 5 years is 2 years, and 2 years is tomorrow. So I think if you're thinking it's 30 years, it'll be 10. I think you're right. For pan-European investors, they go, why wouldn't I just do Germany, et cetera? But I think there are still major global capital flows, and it won't happen tomorrow, that sooner or later they're going to get comfortable with what my premise was earlier, that Europe is not going away. It's bumbling, circus of whatever it is, but it's not going away, and I need to profit from it, and I need a way to do that efficiently. That's what we hear from clients, which is like, look, I'm tired of picking managers, manager in, manager out. They're going to need some ways, to do that efficiently. And those global brands and track records are going to be attractive. There's those of us that want to build that kind of brand awareness and track record that we can compete eventually.
Rick, you said stay in your magic. So I'm going to go down the line. How are you going to stay in your magic for the next few months? That's what we want to know. Where's the magic coming from, Thomas?
In a 90 billion firm,
Yeah.
I mean, it's really hard
To find the magic.
Actually,
Yeah.
I must say I'm a manager of managers, so I have to make sure that I keep my team happy and together.
Yeah.
We more and more and always we focus on investment performance. So it's the magic is at some point in time just to say no. Sometimes to go back to your investors and say we can't employ your money, not to do the 10 to 15%, because we never were in that space really, because we are staying in the core space, and we have to play the magic there.
Paul Richards.
I think, well, apart from getting my daughter to learn fractions, helping us with that.
Yeah, I feel your pain. I'm in the same position.
I guess there's a lot of sympathy there. What our clients are needing at the moment is solutions to problems, and real estate is part of those solutions, but we're finding it sometimes it's only part. And what we're spending a lot of time doing is putting together solutions which have got some kind of real estate and some kind of bond that I don't quite understand, but my bond colleagues do, and some infrastructure and so on, and creating a solution across asset classes that fits a client's requirement, rather than saying, here's some real estate. So it's looking at things the other way.
Paul, you've already found your magic this year. Big promotion, right? 2 weeks ago you were head of real estate. Now you're head of, what is it? Global head of real assets.
Yeah.
So congratulations.
Thanks.
The magic's there. The magic's there. What about the business?
So I think the magic for us is probably in looking a bit holistically. So similar to what Paul's just said, our clients don't ask us for real estate private equity. The title on this slide is how can we get a good risk-adjusted return from real estate? So to something Rick mentioned earlier about keeping things simple, the simplest and best performing thing you could have done in 2008 was just buy a basket of REITs. They were trading at such big discounts. You'd have got 100% invested straight away, and you wouldn't have to kind of do the expensive fees, the drawdowns, etc. So thinking holistically has helped our clients, and we did do the REITs in 2008. And today, for example, the mega malls in the US are trading at implied cap rates in excess of 6%, whereas the underlying assets would be probably in the 4 cap rates. So little opportunities like that, I think, can help our clients. But very few managers are set up to holistically look across that space.
Yeah, so true. Jonathan?
Yeah, I mean, it's surprisingly not too different for law firms. We're not just about papering a deal. Law firms are now taking on roles of bringing deals and bringing clients together and being the interface between people to share ideas and to find synergies and to bring joint ventures. So in the real estate space, if I'm acting for, or if one of my clients is a developer in London and I've got a colleague of mine in Singapore who's got somebody who's looking to get exposure to the region, then it's about bringing those opportunities together and to be the facilitator for new deals. So for us, that would be the ideal, not just to document the deal, but to actually be there at the outset, bringing the deals together, bringing the clients together.
Great answer. And it's only right, Rick, you get the last word, seeing as you coined the phrase, so to
Yeah,
speak.
I mean, I think it's more attitude, as I was saying, more attitude than a tactic. You know, I think we're going to continue to do what we've been doing: work hard, play hard. You know, bring enthusiasm to everything we do, and try to get more wins than losses and ties.
Thanks for your enthusiasm. Perhaps we can give them an enthusiastic round of applause. Thank you. Over to you, Richard.
Thanks very much, Robin. Thank you, panel. That was very interesting. I learnt a lot of things there. Edward, I was just about to announce we were going to do a whole series of 2.5-day conferences, but I won't do that now. No, I mean, we're going to do more of these, looking at different forms of capital and how they interact in the real estate markets. But again, as Rick says, short, focused, don't waste anybody's time.